Welcome to the Daily Update Podcast, where I'll go over the action in the market for Tuesday, November 25th, and we'll see how things look for Wednesday, November 26th. The S&P 500 closed higher by 0.91% at around the 67.67 level, pushing within striking distance of all-time highs once again. Since last Thursday's sharp drop, the index has now recovered about 4% in just 3 sessions, with gains holding firm into the close and no significant selling pressure evident. Volume, as expected during Thanksgiving week, remained below average and will probably continue to stay below average, as well as in Friday's session with the early close at 1 p.m. Eastern. Looking over some key technical developments. From a technical perspective, the most important story on Tuesday is that the S&P 500 has flipped fully positive across all 3 major time frames. The S&P has been able to recapture both the 20-day and 50-day moving averages, turning the short and intermediate term trends bullish. The Parabolic SAR has also flipped bullish, and the ADX, while still weak and below 20 and not trending, is now turning positive with the green line above the red line. And one of the most significant events is that the index is back above the Ichimoku cloud and the 50-day moving average on most major indexes. The VIX dropped back below the key 20 level, closing at 18.56, a clear sign of calming risk perception. Moving over to sentiment and breadth, not everything is perfectly aligned. There continues to be a confirmed Hindenburg omen in the background, an unconfirmed bearish warning that historically precedes meaningful declines. Sentiment surveys remain extreme negative, and the put-to-call ratios have ticked higher, suggesting some hedging ahead of the long weekend. On the positive side, breadth is improving. Advancing issues are expanding, new highs are picking up, and both the McClellan Oscillator and Summation Indexes for the S&P and NYSE have turned positive. Moving over to sector rotation and leadership. Leadership still remains defensive. Healthcare is up roughly 10% in November alone and just printed a fresh 4-year high. Staples and utilities continue to outperform. Value did beat growth on Tuesday, and small and mid caps outperformed the large caps, which is classic rate cut sensitive behavior. Tech and semiconductors, including Nvidia, lagged. Moving over to rates, the dollar, and the macro environment. The 10-year Treasury yield has retreated back down to 4%, providing a tailwind for stocks. The markets are now assigning a higher probability to a December Fed rate cut, following more dovish FOMC commentary over the past few days. The dollar index is slipped below 100, which is broadly supportive for risk assets. Tuesday's economic data was mixed. Consumer confidence came in weaker than expected. Housing was a bit soft in some areas. PPI was in line, but the market has largely shrugged off these reports as being old news. What are the risks and cautions heading into Wednesday? A few things to keep in mind. Volume may taper off in holiday-thin liquidity, which can produce outside moves or whipsaws on relatively small volume. Overhead resistance sits at around the 6,800 level, prior pivot point highs, and a Fibonacci level on the daily pivot point chart. Growth versus value and discretionary versus staples remain negative on a short-term basis. The lingering Hindenburg omen deserves respect until it's fully invalidated, which is 6 weeks using calendar days. Looking ahead to Wednesday, the bias remains positive on all time frames, but conviction is tempered by the low-volume holiday environment. Seasonality, the day before Thanksgiving and post-election years, have been strong going back to 2002. Any meaningful progress on the Russia-Ukraine peace talks would likely act as an upside catalyst. In conclusion, the S&P 500 has reclaimed key technical levels, flipped more bullish, and is benefiting from renewed rate cut optimism and a softer dollar. Gains continue to be led by defensive and rate-sensitive areas, with volume starting to taper off. The near-term direction lacks any strong conviction as we head into the long weekend. Expect choppy range-bound action unless a major headline or large institutional flow disrupts the quiet tape. Thank you very much, and I will talk to you in the next podcast.